Good morning, everybody. Welcome to this webinar brought to you by RHB Investment Bank. So this session, we are very honored to be looking at this topic, which is market outlook, second half of 2023, a panoramic perspective. All right, welcome everybody to this session. So today, we'll be addressing some of the key concerns that investors may have in the market, such as is US recession looming? Is US in the banking crisis? Is tech sector at the tail end of the down cycle or at the beginning of the down cycle? So these are the key questions that we know from investors. So today we're going to address this question through this market outlook, second half of 2023, a panoramic perspective. All right, so welcome everybody. My name is Shin Chu. I'm the moderator for this session. So before we begin, I just want to do a quick disclaimer. Whatever we share in this session is only for educational purpose. So you know whether I give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risks. Now, allow me to introduce our first speaker for today. And he's none other than Mr. Peter Lim. Now, Mr. Peter Lim is a founder and head of research for Trident Analytics in Berhad, an independent research house that focuses on global economy, market, and industries. Graduated with a first-class honors in accounting from University of Malaya, he played numerous roles in the fund management industry, ranging from head of research, head of equity, and chief executive officer for various local and global asset management firms. So today, we are very honored to have you here, Peter. How are you, Peter?
Yeah, I'm good. Thanks for having me here, actually.
Cool. So we can't wait to learn from you about the market outlook for the second half of 2023. So let me hand over the session to you.
Yeah. Okay. Hi. Thanks for joining this Saturday morning. But thanks for dialing in. Let me open my slides. Yeah. Okay. Here you go. Okay. Now, a disclaimer. Today is purely for education purposes. So if you happen to say any stocks, it's not a stock recommendation. So first, let's look at the US interest rate. Of course, this is quite a well talked about thing. So this is starting from the rate hike we had in 2022 all the way where we are now. And of course, now the latest consensus is people are still expecting another 25 basis point hike. My take is, I think he has reached the peak. I don't think the market needs another 25 basis point hike. To be honest, that's my view. But if you look at the possibility, is 75% of market participants are expecting another 25 basis point hike, right? But if you look at it where we are now, this is a chart of the US interest rate and all the hike until 2022. The forecast for 2023 is 5.1, where we ended the year 2022 around 4.5, right? But look at the further forecast will be 2024 will be 4.1, which is another 100 basis point decrease, and 3.1% in 2025, which is another 100 point basis increase. So what I'm trying to say is the tapering of interest rate or pivoting of interest rate has expected to be in 2024. So long and short, 2023 will be the last era of period of high interest rate. And starting from 2024 and 2025, we are going to see high chances of a decrease in US interest rate. But even at the current 5.1 interest rate, this gives you a very good long-term perspective, right? Actually, even at 5% interest rate, it is not out of normal interest rate. If you look at long-term US interest rate, it has always normalized at 5%. Of course, that normally in interest rate in 1979, which the interest rate spiked up to 20%. I mean, that's another long story behind, right? But long and short, even at 5% interest rate, it is not a level that actually suffocates economy. Economy are still doing very well even at a 5% interest rate, right? Okay, now, high interest rate, will it cause a recession? I think we have been hearing this word recession, I think, since the second half of 2022. But until now, we are still not seeing it. But then the question is why? I mean, will a current high interest rate really cause a recession? So to answer that, I think I always like to use this chart. This one actually talk about the past US recessions since 1929. So this is a very long-term perspective of US. The blue line is actually the S&P index, and the gray shaded lines are actually US crisis or economic crisis in the US. So if you look at it, there's total of 15 lines there since 1929. You look at in 1929, the crisis was the Great Depression. It lasted from 1929 August to March 1933. The second was actually in 1937, 1938. Then in 1945, we have another US recession due to decline in government spending. 1948 was the fall of investments in the US after World War II, which caused a recession. 1953, another recession due to Federal Reserve restrictive monetary policy, again after Korean War. 1957, Fed tightened for policy. 1960, interest rate hike by the US Federal Reserve. Then, of course, then there's this 1969, after Vietnam War, fiscal tightening by the US Federal Reserve. 1973, this is due to the OPEC hiking oil price substantially, which caused a shock to the market, caused a recession in the US. 1980, Federal Reserve increased interest rate, caused a recession. 1981, Iranian revolution and energy crisis, global shortages of oil, which caused a recession. 1990, multiple issue. Of course, you have interest rate hike together with oil shock and debt accumulation issue in the US. March 2001, of course, we have dot-com bubble, which actually caused a very short recession in the US. 2007, the most recent global financial crisis due to subprime debts. And of course, March 2020, the start of COVID pandemic. So since 1929, in total, there are 15 US recession. What is interesting, if you look at it, if you notice, I separated those arrows at the top of the blue line and those arrows at the bottom of the blue line. Those arrows at the bottom of the blue line actually are recessions due to Federal Reserve hiking interest rate. Okay, now, of the 15 recession since 1929, 7 are actually due to Federal Reserve hiking interest rate. That means, give and take, 50% of US recession were actually due to Federal Reserve tightening policy. Okay. Now, if you note, again, very interesting point. The last recession that was caused by Federal Reserve hiking interest rate was way back in 1990, which means for the last 33 years, US has not went into a recession simply because Federal Reserve hiked interest rate. So I repeat, right? For the last 33 years, Federal Reserve has increased interest rate many times, but none of this interest rate increase has caused a recession in the last 33 years. Why? Simply because after a good round of experience, after experiencing 7 recessions because you were hiking rate, I think Federal Reserve have gone sophisticated enough to actually manage the whole rate hike situation without causing a recession. Inflation is already coming off, which is, of course, another good reason why I think that the rate hike trend is over. The long-term target for the US, the Federal Reserve, they are aiming for a 2% interest rate, but honestly, I think that's a bit too low. Personally, this is a very personal opinion. I think US inflation rate in the new going forward, I think should normalize at 3% rather than 2%. Again, this is a US inflation rate history. Okay, now let's talk about recession, right? Another reason why I've been saying this since last year, I don't think US will undergo a recession. Okay, this chart actually shows the cash assets in all commercial banks in the US. I mean to say, if add in all the commercial banks in the US, how much cash holdings these banks have. And you can see from the chart, the banks are holding a lot of cash. Okay, why this is critical, right? This is critical because, don't forget, the banks are the linchpin of economy. A recession happens when the banks are short of cash. So when the banks are short of cash to loan to the economy, that's where recession really happens. But if you look at where we are now, the banks are actually very flush with cash. So it is really hard to imagine a recession in an environment where banks are having very cash rich. Now, another parameter is US corporate profits. After the pandemic, market surge. And of course, there's a lot of comments saying that this is the all-time high indices for the markets, and market are really overheated per se. Right? This was, remember, in 2021. But if you look at the other aspect of it, US corporate profits have also improved during that period. Right? So the surge in the market in the US was actually supported by a surge in corporate profits. And likewise, you notice there was a downtrend in corporate profits in the last 6 months, last 6 months to a year, and therefore the index also moved accordingly. Right? So what I'm trying to say is, always remember that when you look at the stock market, it's always supported by corporate profits in the US. Yeah. Okay. Now let's go for the technology. I think the most market consensus is that the tech sector is still very painful. That there will be further downtrend. I think I'm quite having a different view. I think I've been saying that my take is second half of this year, you have a reversal of tech. The tech sector will reverse itself. Why do I say so? Many parameters. Number one, if you look at in terms of the semiconductor space, the slowdown in the tech sector we've seen for the last 1 year, 1.5 years to be more exact, was actually due to over inventory build-up in the tech sector, right? But we are starting to see inventories normalizing, right? It has not become shortage, but inventories have started to normalize, except for the memory segment, right? In the non-memory segment, inventories have started to normalize, where second half of this year, you're going to see a recovery of demand per se, right? So I'm quite anti-consensus on this. I think the tech sector actually has reached the bottom, and I think you're going to see a rebound in the industry in the second half of this year. Now, let's talk about this chart, which again was capturing the headline in the last 6 months. I think we always hear about tech layoff, right? About how big that in how industry was so challenging that people like your Microsoft, your Google, your Amazon or Meta have been laying off employees. But I want to give a different perspective to it, right? I think this layoff should be viewed in totality. What doing that in totality is, we should have looked at what was the hiring starting from 2020 versus the layoff. Okay, let's take this chart, for instance. Let's look at Microsoft, the first one, right? Since 2020, Microsoft actually hired 77,000 new headcounts, and the recent layoff was 10,000. So what it means is, from the start of the pandemic until now, Microsoft actually increased the headcount by 67,000. Google hired 67,000, laid off 12,000, net, they actually hired an additional 55,000. So on and so forth. Amazon, big number, they've actually laid off 18,000 since the last 6 months. But not forgetting, since pandemic, they actually hired 746,000. So what I'm trying to say is, the current layoff number is really overblown by the markets, right? But we have to compare with what was the total hiring for the period. Okay, now let's put it this way. Assuming Microsoft, for the last 3 years, they hired 77,000, and assuming now they're laying off 100,000, then I'm worried. That is really a bad news. But if you're hiring, if you have hired 70,000 and you're only laying off 10,000, I think that's the perspective people should really understand more. And likewise, we hear a lot of doom and gloom about the NASDAQ, the tech sector, and the most common thing we hear early this year is, you haven't seen the worst. S&P is going to collapse further, NASDAQ is going to collapse further, this is not the worst, etc., etc., etc. But if you interestingly look at it, year to date, NASDAQ is already up 30%. S&P is already up close to 10%, right? So despite all the doom and gloom, I think market is really moving the opposite direction to what is commonly said. Okay. Last on the US, will there be a recession? Again, no, right? And this just came in yesterday. US economy defies expectation of slowdown to add the 339,000 jobs in May. Okay, now, you may find some contradictory data between the previous slide, where we talk about tech layoff, but then you'll be saying, hey, if there's such a big layoff in the tech sector, why is the US economy still adding jobs? I think the biggest thing we have to understand is, those who were laid off in the tech sector, they actually found immediate employment in the conventional sector. Okay, what I mean by conventional sector is the banking system, the pharmaceuticals industry, etc. So these traditional, conventional industries are actually hiring a lot of tech people to actually move their business in the new economy. So all these who were laid off in the tech sector, they were not unemployed. Actually, they were actually employed quite immediately to other sectors. That's the reason why you're still seeing very strong job growth in the US despite a very big layoff in the tech sector, right? Will there be a recession in Malaysia? Next, I need to go a bit fast. Where's my time? Sorry. No, I think there's no recession. Again, I'm quite having not so pessimistic view. I think some were saying that we don't have a recession. But to answer the next question is then if there's no recession, then why our market is so bad? I think the key hurdle is our upcoming state election. I think that's the biggest concern in a lot of investors' mind. I think the benchmark is very simple. As long as the current coalition government can maintain whatever seats they have, that is a very good news. If they can increase slightly the seats they have, it will be very good news. And if they lose more seats than where they were, then it's not so good news. I think that's a very simple expectation on the upcoming election. Industry that will do well in 2023, I'm talking about this, especially on the Malaysian market. The sectors that I like in Malaysia is number one is automotive, building materials, semicon, especially in the OSAT space. I like the OSAT space, consumer retail, and also aerospace. I think these are the key sectors in Malaysia to look at for 2023. Let's talk about Malaysia Auto. This chart actually shows the historical sales of automobiles in Malaysia. The blue line is actually passenger car, the orange line is actually commercial car. So 2022 was the highest ever. Passenger car 641,000, commercial car 78,000 in total. I think we sold 715,000 cars, the highest in history. Okay, now, I'm not denying the fact that 2023, you're going to see this number normalize or even reduce. So common projection is likely there will be a 10% decrease in passenger car sales in Malaysia in 2023. And the biggest reason usually people give is because last year we have this sales tax exemption. This year we don't have sales tax exemption, so therefore car sales will drop. Okay, I'm not denying that fact, but I think although total industry volume will fall, there will be still two brands that will do very well. This was the breakdown of sales last year. Perodua sold 282,000 in total. The next one is actually Toyota. Sorry, I think the logo, the name disappeared. The third was actually Honda, followed by Mazda, etc. Hey, sorry, 136,000. No, sorry, the second was actually Proton, right? I think I forgot to add Toyota to this chart. I apologize. Toyota sold around 110,000 last year. I forgot to add inside here. And the best car we call the king of the road, of course, Myvi. In 8 months of 2022 numbers, they already sold 48,000. These are the top selling. The king of the road, of course, Myvi. Okay, sorry, I need to skip this one a bit. These are the various brands. Okay, what I'm trying to say is 2022, as I mentioned, they'll be expecting only two brands that can continue to generate sales growth. Number one, of course, is Perodua. If you look at Perodua, the model launches is actually very interesting. Last year, they actually launched the Alza replacement model in the second half. If I remember, it's October, and the demand is actually very strong. If you just drive your car along the road, you see left, you see right, you're going to see Alza quite often. The next was actually early this year, they launched a new Azia. Demand is also very, very strong. So what I'm trying to say is, one of the brands that can still continue to record volume growth in 2023, despite the industry volume going down, number one is actually Perodua, right? Number two is actually Toyota. Toyota Cross is still doing very well, very, very good pricing. And recently they launched the new Vios. I mean, they call it what, Defy. You know, the marketing was Defy in Vios, also doing very, very well. And the upcoming launches, which I think is very interesting, is the upcoming Innova replacement model. Guesstimate maybe second half of this year. And this is actually the design in Indonesia. And for those who like car or familiar with Innova, I think you agree this design looks way, way, way much better than the current Innova that we have. So I think this Innova is going to be quite a hot item, right? And it was rumored to be, it will also come with a hybrid powertrain, right? So again, I think Toyota this year sales will actually surpass 110,000 units of what they delivered, right? So that's the reason why I'm quite keen on auto in Malaysia, in particularly Toyota and Perodua. So this is also the Innova replacement model. This picture is not Malaysia, this is Indonesia. It looks pretty cool. Yeah. Consumer, I like the consumption space, especially Starbucks. Yes, noted recent quarter due to cost pressure, the profit was down. But look at overall Starbucks, I think at the current valuation is very cheap. Sorry, it's not a stock recommendation. I take back my word cheap, sorry. It's a very interesting company. I think that's a better word. I have yet to see a Starbucks that's empty, to be honest. I think that's the best indicator I'm using. Every Starbucks that I go, is still packed. And that actually shows the brand power. I like OSAT, as I mentioned, in the tech space. OSAT, simply in the layman terms, they are companies who actually help to package semicon chips. Semicon chips in the very raw form doesn't come with a plastic, I want to say plastic, because it's a very raw form. So packaging are those who actually encapsulate the chips for a protective barrier. Okay, what's interesting is, I think our Malaysian OSAT are underrated, right? This chart actually shows the world top 20 OSAT in 2020. I don't have the latest number, but in 2020, these are the world giants of OSAT. And what is interesting is 3 of them actually Malaysian. CarSem, which is of course under MPI, Unisem, and also Inari. So what's interesting is, I say it's underrated because 3 of our OSAT are actually among the top 25 in the world, right? Third is building materials. I think recently the cement, the latest result by the cement companies actually quite surprised the market. But I mean, those who have been following it, it's not surprising because I've been highlighting that a lot of people somehow are not aware or forgotten that in November and December last year, there was actually 2 hikes of cement prices. And this hike of cement prices really transformed the whole profitability of the cement business. And that's why when I remember in the first quarter, Hume reported a very strong set of results, and so is Malaysian Cement, the 2 listed players in Malaysia. I think cement prices will sustain. Any pressure to reduce cement prices, I don't think it's going to happen. So likely the profitability of the cement players will only improve going forward. Yeah. Aerospace. It's a very interesting segment because of the COVID pandemic. A lot of planes are being put out of operations, and no plane orders was actually happening for the last 2-3 years. But what is now with the resumption of travelers, there's actually a shortage of airplanes globally, and aerospace is now thriving, very in demand. But then again, I must stress, right? To build an aeroplane from the beginning, you want to build to the whole value chain, to the whole completion. It takes at least 5 to 8 years for you to get your plane. So it is a very long cycle segment. But aerospace is very, very interesting. The 2 biggest exposure we have to aeroplane, there's only 2 companies so far in Malaysia. One is, of course, UMW. So people know UMW for their Toyota cars, but I think people are not aware that they also have aerospace division. Another one is actually SAM Engineering, which also have an aerospace division. So I think that's the last of my slide. I'm on time. Okay, I'll pass it back to Shane.
Thank you so much, Peter, for sharing your perspective of the market outlook for the second half of 2023. So next up, we're going to invite the warrant specialist from the equity derivative group of RHB Investment Bank, Mr. Andrew Lai, to share with us how do we navigate the market and amplify our returns with structured warrants in the second half of 2023. So without further ado, let me hand over the session to Andrew.
Okay, let me share my screen. Good morning, everybody. Thank you for joining us here on a Saturday morning. Here we go. Okay. Right. So here today, I want to talk to you a little bit about structured warrants and how it can help you generate outsized returns potentially, right, in the market for second half 2023. Now, first of all, I'm not sure, but I think a lot of people would like to know exactly how a structured warrant works. So I'm going to start with the basics where what is a call option, okay? So if you see here, call option is basically giving the buyer of the call option the right, but not the obligation to buy a share at a certain price at maturity. And that price is called the strike price. So you see this chart on the right here, right, where there's no downside below the strike price, but you have upside above the strike price, right? Because if the shares are below the price, the strike price, the investor doesn't have to exercise it and buy the share. You can just walk away, right? So this gap between your so-called a bit of a loss here is basically what we call an option premium, right? Which is made up of two things. Now, what is an option premium? It is basically the cost of buying this option, the right to buy the shares at a strike price, right? And it's made up of two things, intrinsic value as well as time value. So let's take a look at each of them, right? The intrinsic value of an option is basically how far in the money you are for a call option, right? Let's say an example where the strike price is 5 ringgit for a share, right? And the share is traded at 6 ringgit. That means your option has an intrinsic value of 1 ringgit, because if you exercise the option to buy the share at 5 ringgit, when the market price is 6 ringgit, you immediately have a 1 ringgit profit. Notice here how if it drops below 5 ringgit, there is no negative value for intrinsic value of an option premium. And this is because if the share price at maturity is below your strike price of 5 ringgit, you don't have to exercise the option, and therefore there's no cost to you. So there's no negative intrinsic value. Now, the second part, which is time value, is basically the value of the uncertainty of the share price between now and when the option matures, right? Because remember earlier we said that if the share price drops below the strike price, you don't lose money. But if the share price goes above the strike price, you make money, right? So you gain intrinsic value. So in that sense, the more time you have for the share price to move, the more valuable it is for the person who holds the option, right? So if you look at this chart on the right here, just as an example of time value decay, if the option expires, say, on 1st of August, right? And you have the time value for April, May, June, and July with no change in share price, you can see that the time value of the option is slowly reducing as there is less time to maturity, or the closer to maturity you get, right? So these two components make up what we call an option premium. What then is a call warrant, right? Different name, but it's basically the exact same thing, but with a few added features. A call warrant is basically an option that is listed on the stock market, and you have a market maker at the back to provide liquidity, right? What does that mean for you as an investor? That means you don't have to wait for maturity. When there's a listed on the stock exchange and there's a market maker to provide liquidity, you can always exit or sell your option away during the tenure of the option. So you don't need to wait for maturity to see whether you made money or not. If the value of the options has gone up, meaning say the intrinsic value has increased because of share price movement, you can sell the option back to the market maker and you can make your profit. Similarly, if you think that, oh, maybe the share price is not going in the right direction and there's still time value to my option and you want to get out, you want to exit, right? You don't have to wait for maturity and then have a zero payoff. You can exit it early and realize the time value remaining on your option, right? What benefits does something like an option or a call warrant have to the investor, right? You have a very low capital outlay generally compared to buying a mother share. So instantly you have what is called a leveraged effect, right? So a leveraged effect means that for every, say, few percent move in a mother share, say 1% move in a mother share, you get a multiple of that movement for the call warrant. The second thing is, when we say the call option, it's a right to purchase a share at a certain price, but you're not obligated to. That means that when the share price drops, or if the share price drops below the strike price, you don't have to exercise the option. That means that your losses are limited to the amount you invest. So this is a leverage product that does not come with any margin calling that you get with traditional leverage, right? So you can lever up, but your loss is limited to your capital invested. And the third thing is, for you guys, it's very easy to buy and sell on the exchange because, once again, there's a market maker behind it, like RHB Investment Bank. So the market maker is always there to provide entry and exit prices on the bid-ask. Okay? So next, we'll move forward to just a few key terms to get you guys familiar with what a warrant is and how to look at it, right? So here we have three things we want to talk about today: the sensitivity, effective gearing, and the time value. Now, time value is exactly the same thing we spoke about just now, so we'll move on to sensitivity first. What is a warrant sensitivity? You see here sometimes, on the websites, like our website here, you show you the sensitivity of this warrant is 2.3 ticks. What does that mean? right? That means in this example here of hibiscus warrants, the warrant will move 1 tick when the mother share moves by 2.3 ticks on average, right? So if you see this matrix on the right here, where it shows a range of prices, you can see that on average, the mother share price moves by 2 ticks, the warrant price flips by 1 tick. So that is what sensitivity means. It's how reactive the warrant is to the movement of the mother share. Okay. The next thing we're talking about is effective gearing. Now, effective gearing is what gives you the leveraged effect. And it's always listed down in warrants, and it is variable from a day-to-day basis, depending on where the share price is as well. So do check regularly what the effective gearing of the warrants you have is at the current time, right? For this example, what is effective gearing? Effective gearing is basically how many percentage change the warrants would have in relation to a 1% change of the underlying share, right? So 4 times, that means if the mother share moves 1%, your warrants will move 4%. 5 times means 1% to 5%. And here is where you see the leverage effect of a call warrant, right? So effective gearing will give you exactly what you need to know if you want to know how levered up this warrant is to a mother share, right? Next, one of the biggest benefits of a call warrant is the lower capital outlay. Now, this is just an example here, and of course, this is not indicative of any future performance whatsoever, but just an example to illustrate the leverage effect of a call warrant, right? And how it uses a lot less capital for you guys if you want to invest. So we have an example where, let's say you're looking at Maybank shares, right? Maybank shares at 8 ringgit 60 cents on day 1. Now, let's say you want to buy 1,000 shares, 10 lots, sorry. So 1,000 shares, that will cost you 8,600 ringgit in capital. And let's say on day 2, it goes up to 8 ringgit 88 cents or 3.26% increase in share price. Then your profit on day 2 is 280 ringgit from an investment of 8,600, right? Now, here we see the Maybank call warrant, Maybank C1C, which is actually something that RHB Investment Bank has issued on the market today, right? The price of the warrant is 8.5 cents. Okay, to get a roughly equivalent exposure, you need to buy 14,000 units, which costs you 1,190 ringgit. Now, 1,190 ringgit is a lot less than 8,600 ringgit capital outlay. But if you look at day 2, the corresponding price for when Maybank shares are priced at 8.88, the warrant is expected to be priced at 10.5 cents, which is a 23.5% return on your initial capital, right? So you see this effective gearing here. This is 6.9 times the percentage change, right? So from a 1,190 ringgit capital outlay on Maybank C1C warrants, for the same change in price of the mother share, you make the same return of 200. You can make the same return of 280 ringgit, right? So this is where you see the leverage effect, as well as how you need a lot less capital to get the same exposure or similar exposure to the mother share. It's a lot less capital intensive compared to direct equity investing. Of course, when it comes to investing in a levered structure, the downside is also amplified. But however, with structured warrants, the downside losses are actually compared to buying the mother share directly. Now, what do I mean by this? Now, let's just take an extreme example of if Maybank shares drop by 50%. As a very extreme example, and I hope it never happens, but if it does drop by 50% or some large amount, then, as a share investor, if you buy directly into the Maybank shares, you would have lost 4,300 ringgit or half the value of your capital outlay, right? But on the other hand, if you buy into a warrant of 8.5 cents, where your capital is only 1,190 ringgit for a very similar exposure because of the leverage effect to Maybank shares, and let's say Maybank shares drops by half, right? And your warrant value is completely wiped out, is 0. Your loss is still only 1,190 ringgit, which is a lot less than the loss you would have made buying the Maybank share itself. So this is what we call lower capital at risk because the amount that you've put in is a lot smaller, the amount you can lose is also a lot smaller. Okay. So next, we'll move on to some of the warrants that we have on the market today, and we'll talk about that. So first things we want to talk about Malaysian automotive sector, right? Now, we mentioned just now, Peter has just talked about the automotive sector on how Toyota and Perodua are some of the key players in the market who are potentially looking at some good second half of 2023. Now, we do have existingly a UMW C41 warrant on the market expiring on 29 January 2024 with an effective gearing of 4.5 times. Now, UMW as a company, as Peter has already mentioned, because of the Toyota and Perodua exposure, is very strong. It also has the aerospace division that is one of the only 2 companies in Malaysia that has it, right? So in terms of automotive sales, actually, they already have a 43,000 unit order backlog for Toyota cars for this year and 190,000 backlog for Perodua cars this year. Now, of course, I'm not saying whether this share is definitely going to perform or not going to perform, but if investors are keen to take a view and a positive view on UMW, and you are keen to gain some kind of exposure to the stock, then UMW C41 warrants might make a lot of sense because it gives you the gearing effect. At the same time, your capital outlay is a lot lower than buying the mother share. Now, the next counter we would like to highlight to investors today is the tech sector warrants, which is primarily what we're looking at here is Inari C1Z. Now, Inari is one of the top 20 OSATs in the world, one of the largest in the world, and also one of the largest in Malaysia, of course. Now, we all know that there has been a semiconductor supply glut starting late last year and rolling into this year, right? So you've seen the share price of Inari come down quite a fair bit as well. Now, if you look at the chart here, it's on a slightly downward decline over the past 1 year period, but with a slight uptick at the tail end. Now, why is there a slight uptick? Well, recently, Broadcom, which is one of Inari's biggest clients, has announced that its new deal with Apple for a 5G radio frequency chip. So the idea is that Broadcom will be supplying Apple with the radio frequency chips that are developed together, right? And Broadcom being one of Inari's largest customers, is expected to gain from this deal with more volume coming in as the deal gets carried out in the next few years, right? However, one thing to note is that the details of the deal between Broadcom and Apple, and they always say the devil's in the details, that has not been disclosed to the public. So whether there's further upside or something good news in there that we've not known, well, I can't say much about that. And I don't think anybody really knows about it except for the insiders itself. So investors who are keen to take a view on that and say, maybe there's something in there that's really beneficial for Inari. Well, Inari C1Z with a high effective gearing of 5.3 times can give you a good view on the potential of this deal between Apple and Broadcom's effect on Inari. It gives you a levered effect. And at the same time, because it's a call warrant and your capital outlay is low, as we mentioned just now in the Maybank example, if in fact the details of the deal does not give any upside to Inari at all and everything comes crashing, your capital outlay is small and your loss is also limited. So Inari C1Z. And the third thing we want to highlight a little bit today would be a Hong Kong tech sector warrants. This example we have here is Alibaba C26, which I think, as everybody know, the news flow on Alibaba is constant and always creating some kind of a bump in its share price, whether it's a uptick or a downtick, good news, bad news. There's always something on Alibaba, right? And also recently, the biggest good news, or at least biggest news coming out of Alibaba will be its ChatGPT rival, its AI rollout on its DingTalk and Tingwu platforms, which is used mostly in a business scenario. Now, the question that a lot of investors might have is this AI rollout going to be on a larger scale in the future to all its consumer platforms, and how does that affect the business of Alibaba itself, right? So investors who are keen to say, take a view on this, or even just take a view on Alibaba in general, and expecting a next new flow to see a bump in the share price, you can look at Alibaba C26. Alibaba C26 has an effective gearing of 4.7 times, and it's primed to let investors capture the upside of Baba shares in the short term. Okay. So next, we want to talk about our warrants on the market. Now, we have actually, RHB Investment Bank, we have a total of 124 warrants listed on the stock market today, of which 108 of them are Malaysian stocks. And we also have, and maybe a lot of investors still don't know this, is that we have also Hong Kong stock warrants. So you can get exposure to Hong Kong stocks, like the Alibaba example, listed right here on Bursa Malaysia, at and all priced in ringgit with no FX conversion required by yourself. Now, of the 16 Hong Kong stocks we have, I've listed them all here. You can take a look here yourself. But one we want to highlight is also BYD C18, right? BYD is one of the companies that were backed by, I believe, investor Warren Buffett as well. And it's one of the largest EV companies in the world. In fact, if I'm not mistaken, in China, they've actually sold more units than Tesla itself, right? So now BYD is also coming into Malaysia, and they're doing a global expansion. So anybody who is keen, investors who are keen to take a position and say, okay, BYD has some upside, you can take a look at BYD C18 as well. And I'll leave this slide with all our other warrants up for a short while for you guys to take a quick look while I have a sip of water. Okay. Next thing we want to highlight to you would be the usage of our RHB Warrants website. Now, what can you find on our Warrants website? Now, first of all, you can find all the details of all the warrants listed on the market, whether it's issued by RHB or it's issued by other issuers. We have the details on there, and this is called our warrant search function. Now, this is a very important tool for investors to compare the warrants and choose the right one that suits your requirements. Now, I've highlighted here in the red box the warrant sensitivity and the effective gearing, which is listed down there. And so that, this is something where you as an investor would want to know before buying into any warrants. So this warrant search function is very, very useful for investors who are looking for, you say you have a counter in mind, and you just want to find the warrants for that counter and what suits your risk appetite. The next thing that is very important is the warrants matrix. Now, warrants matrix sounds very high-tech, very different, but basically what it is a table that references the bid-ask price of a mother share to the bid-ask price of the structured warrant. Now, on our website, we will publish all of RHB issued warrants matrices, right? It will show you exactly, say, let's take an example of Inari in the middle, right? It will show you exactly, if the share price is 2 ringgit 52 cents on the bid, what is the Inari C1Z bid price or ask price, and so on and so forth. So this is a very, very powerful tool for investors to use when you trade warrants, because you know exactly where the warrant price would be when a share price, the mother share, hits a certain point, right? It's also a very transparent way for market makers to show you that this is exactly what I'll be bidding and asking at when it comes to actually doing the market making. So you can be assured that our traders are seeing the same data as you are when it comes to market making. Now, this is only updated 10 minutes. Every 10 minutes, the matrix is updated on the website itself. So there might be some discrepancies in between there, depending on how the share price moves and if there's a big change in volatility or whatnot. But in general, in regular usage, this is exactly how our market maker works as well. And all this, warrants matrix, warrant search, as well as other tools for you guys, if you're going to learn more about warrants, information about it, and daily updates, you can find it on our website at warrant.rhbgroup.com. Or if you don't want to remember this, all you need to do is search RHB space warrants into Google, and it's the first thing that comes up for all of you guys to take advantage of and use the powerful tools to trade so that you can benefit from all those given structures on the market. We also have a Telegram group where we have daily updates on what's happening in the market, what warrants are moving a lot today, and basically throughout the day, if there's any breaking news on any international or global events, we will update into our Telegram channel as well for you guys. And that's it for me today. I'll pass it back to Shane for questions and answers.
All right, thank you so much, Andrew, for sharing with us how do we use structured warrants to navigate the market and how to use it to amplify our returns in the second half of 2023. So if you have any questions to ask both our speakers today, you may write them in the Q&A box, not the chat box, okay? Write them in the Q&A box and we will address the questions accordingly. Okay, I have already got a couple of questions on my panel. So the first question I think will be addressed to Peter. Now, wasn't US subprime mortgage crisis indirectly caused by the hike in interest rate?
No.
That's asked by Lim.
No. You see, US subprime crisis was not due to high interest rate. It's due to subprime mortgages. Mean to say the whole trigger of the great financial crisis in 2008 was because technically low quality bonds, right, were actually packaged together and being sold as high quality bonds, right? So when the reality comes, when housing prices start to adjust downwards, all these low quality bonds were affected, and therefore you have a collapse in mortgages value, in the value of the mortgages and the value of the bonds. So no, the great financial crisis was actually due to a subprime product, meaning to say bonds that are of subprime quality being sold worldwide, and which was caused why the matter was so big, because all these bonds were sold worldwide. I mean, even our neighbor Singapore bought it, I mean, to a large extent, right? And they were hit by it.
All right, thank you so much, Peter. So the next question is by Sufyan Yaakov. How could semiconductor sector be of preference when reports say that the global semiconductor chips are already oversupplied?
That's a very good question. You see, semicon is a very general word, right? Let's look at semicon can be classified in many ways, right? One way is by usage. By usage, mean to say, are you talking about a logic chip which powered most of your devices? Are you talking about memory chips, which is to store memories? Are you talking about graphic processing units, etc., etc.? Or are you talking about optoelectronics, which is your LED? So all those are generally being categorized as semiconductors. So whenever you look at, people say, oh, semiconductor is on the downtrend, semiconductor is on oversupply. I think people don't look at it specifically. Okay, let's look at this situation. The oversupply now is on memory chips. There's a big oversupply there. But if you look at automotive chips, meaning to say chips being produced for automotive, there is a shortage there. But because percentage of memory is much bigger than percentage of auto, it covers the whole thing. Memory is close to 20 to 25% of global semicon chips, which is big. Another way to categorize chips is also by end usage, whether it goes to your consumer electronics, or it goes through your communication devices, or it goes through government, or it goes through military. Again, and it goes through automotive again also. So the one that's also oversupply now is on the consumer electronics, which all of you have bought your laptops, your devices in 2020, 2021, and you're not upgrading it anytime soon, right? So that is where the slowdown is. But again, if you look at in terms of automotive sector, there is still a shortage there, right? But that being said, all the excess inventory we've seen the last 1 or 2 years is coming to an end. So likewise, that is my basis for saying you're going to see a recovery in the second half of this year.
Thank you so much, Peter, for sharing your perspective. The next question is by Queenie. Can we know which PLCs are related to the respective car brands?
Well, it's quite straightforward. The authorized distributor for Toyota is actually UMW. And interestingly, UMW also owns 38% stake in Perodua Distribution. So UMW owns Toyota Distribution and also 38% of Perodua Distribution.
All right, thank you so much. So the next question is by Mr. Abidin. Are warrants only for bulls? I think Andrew will take that.
Yes, I can take this question. So warrants, especially call warrants, especially the one that I talked about today, yes, they're only for a bullish view in the market. But of course, there are also call warrants on defensive stocks. And I think that on the market, you also have what we call put warrants. I didn't talk about that today, but it basically has the opposite return structure compared to a call warrant, where the warrant price will go up if the share price goes down. So it has an inverse relationship to the share price. So yes, we do have put warrants on the market as well for bears.
Yep. So if you are bearish for the market, then you buy put warrants. Okay. So that addressed Mr. Abidin's second questions. The next question is by Chiu. So he has an interesting observation. He said that in the past few years, Bursa Malaysia Technology Index is positively correlated to NASDAQ. But this year, it is not. So could you share with us what is the reason?
It's very simple. It's because of valuation. If you look at it, right, well, when NASDAQ was correcting, right, the level of Malaysia's correction was actually not as severe as NASDAQ because of PE, long and short. When at the bottom of NASDAQ, you can get Apple at very low PE, 20 over times PE. But at that point in time, a lot of our local companies are still trading at 40, 50 times PE. So our PE was really, really high. Okay, now, when NASDAQ starts to rebound now, right, we are having the opposite direction because somehow investors waited until now to realize that the Malaysian tech stocks are overvalued. Don't ask me why now, but they waited until now to realize it's overvalued. So only now they start to realize, hey, actually Malaysian tech stocks are not cheap. So they started to sell down because of PE valuation. So that's why you got the discrepancy of why NASDAQ is going up and now Malaysia is going down.
Okay.
It's an interesting aspect. It's a very interesting.
Yeah. All right. Thanks for sharing your perspective, Peter. So the next question is, what do you think about the US recession indicator inverted yield curve? I think it's much talk about in the market that the inverted yield curve point to a recession soon, right? So what is your view?
I don't know. I personally don't track in inverted yield curve per se because you must understand this, right? There is no number one. There is no single indicator that will be consistently correctly predict anything. Let's be realistic about it. Let's take the most common indicator last time we have. We always said that, gold and US dollars goes hand in hand to a certain extent. But no, there will be parts of the period where the relationship breakdowns. Soybean and CPO also, there were period where there's a correlation of moving toward that, but then relationship breakdown. So you must understand this, whenever there is a recession, analysts or economists will try to find why, and they try to play with indicators to back test indicators to predict, to test whether does this indicator show something. But don't forget, all these are usually a back-tested methodologies, right? So there is no single indicator that works all the time. So yes, my point is, people may be telling me inverted yield curve is pointing towards the recession. But if you look at in reality in the market on the real economy basis, right, you're not feeling it.
All right, thank you so much, Peter. The next question is posted to Andrew. It is asked by Davey. What is the commission rate for call warrant? And what is the liquidity for call warrants?
Sorry, commission rate for call warrant?
I probably refer to brokerage fee or any stamp duty. Maybe
the brokerage fee for call warrant would be whatever. Well, I'll take that in conjunction. I believe there's another question from Richard as well, right? To trade in RHB warrants, can we trade through a regular broker or need to go through RHB? So I'll take that in conjunction since it's quite similar questions, right? So firstly, I'll answer Richard. RHB warrants are listed on the Bursa Malaysia. So anything that can access the Bursa Malaysia, well, whether it's RHB, you're using RHB brokerage, you're using a Maybank brokerage, you're using Kenanga, Rakuten, as long as you can access the Bursa Malaysia brokerage, you can buy RHB warrants. Now, then the next question about the commission rate and what? Sorry, Shane?
And the liquidity for call warrants.
Okay, so for the commission rate, I believe you're talking about the brokerage rate. Well, that will be whatever your respective broker charges you. As I mentioned, you can use any broker to access the Bursa Malaysia, and they will be the ones charging you the brokerage fee. Now, the liquidity of the call warrants. Okay, call warrants always, in Malaysia at least, we always have a market maker behind it, which is the issuing bank. So for RHB warrants, we are actually market making the warrants on the market. So to make sure that there is liquidity for investors to enter and exit. So you can be assured that there's always a backup of liquidity by the bank itself. Now there's going to be extreme cases, such as when we are low on supply, the bid-ask spread or our ask might be a bit further off, or we might not have any inventory, or if the warrant, let's say, is maturing in 5 days' time and it's extremely far out of money, then there's no way that, where the value of the warrant is basically zero, we can't buy it back either. So those are the extreme scenarios where, there may not be liquidity in the market, but in general, RHB will be the market maker for RHB issued warrants, and there's always liquidity.
Yep. I learned that when it comes to trading warrants, liquidity is definitely way more important than the traded volume. Yep. So we must observe the bid-ask spread and the volume behind the liquidity behind the bid-ask spread.
Correct. So look at the depth of the market, the bids and the ask, instead of just looking at how much has been traded during the day.
Yep. So the next question is by Caden. I think it's posted to Peter. So why is ringgit so weak against a lot of currency? Is it due to political instability?
I wouldn't say it's a political instability, right? I think I said the main hurdle we need to cross is the June upcoming state election, right? I think people are just waiting to see how the current unity government performs. I think people will be more assured for the next few years if the unity government show at least retain whatever seats they have or show further improvement in their seats. But then also I must stress, we are in a period where US dollar is strengthening against everybody else.
Yep. So the next question is by Ken Liang. What is your outlook for the crude oil price?
I'm quite anti consensus here, right? My take is the era of oil price. Okay, oil price used to be around $70 per barrel in the long-term average. That will be the normalized price. But I think going forward, oil price likely will be $80 to $90 on the normalized level, right? That's always been my take. Why? I think we need to, I won't say we need to blame it on net zero, but net zero is a big cause of this. What is net zero? Net zero is, the world have actually agreed that by 2050, our carbon emission must be net zero, meaning to say whatever carbon emission we emitted to the atmosphere in that year, we must find ways to reduce the same amount of carbon emission to the atmosphere. So net, you have net zero carbon emission. So the biggest culprit or the biggest target for net zero initiative has always been the oil. The oil sector is always being put on blame on all the carbon emission. So for the last 15 years, you're not seeing major increase in supply of oil or major discovery of oil because of all this pressure. You look at Shell, not only they slowed down their oil exploration, they also sold a lot of their oil assets per se, right? And you look at Chevron, etc. But demand for oil is not slowing down. So we have reached a stage where the growth in demand will not be able, the growth in supply will not be able to cater for the growth in demand in the longer term period. So that will actually push up what I call as a normalized oil price to $80 to $90 per barrel level.
Right. What's your view about coal? Well, coal price has dropped a lot. So will the ICPT cost pass through result in the electricity cost coming down for the industries?
Coal will be volatile, but see, there's the same problem with coal, right? Again, back to all this net zero. Coal is also another favorite candidate of this net zero initiative. But unlike oil, I think coal reserve or internal scarcity of coal is not as let me think, what's the proper word to use? Exploration of coal and coal reserve available is not as low as oil on a relative basis, right? Of course, one is in barrels and the other thing, but oil is more easily available, and there's a lot of big major producers, especially our neighbor in Indonesia, right? So the volatility of a coal price is really dependent on the supply and demand and also the futures contract of it.
Thank you, Peter. So what do you think about the steel and maybe timber and also wood outlook?
I don't look, steel is a very tough business. Okay, why do I say so? Okay, usually any business is a local demand and local supply, correct? If your local demand is good, your price goes up, right? If your local supply is more than demand, your price goes down. But steel is a very peculiar industry. Although your demand is depending on the local scenario, your prices is dependent on global supply, right? So what I'm trying to say is you may have a very good demand in steel locally, but if the global prices for steel collapses, you still have to follow global prices, right? So it's very hard to predict steel prices, personally for me, right? Because the dynamic is just too weird. Timber, I don't follow. I'm trying to be green, to be honest. I don't follow timber stocks also. So again, it's something very hard to. It's best to audit. If you say I got this much of timber reserve, right? How do you verify that you got that much timber?
Yeah. So you're talking about the peculiar behavior of steel. Does it happen to other, commodity like say aluminium?
No, it does. See, aluminum and steel, ultimately, you're looking at China, right? So it's really the China's demand and supply situation that determines the whole prices of steel and even aluminum.
All right, thank you
So
so
I
much,
said
Peter.
that the world is actually China, and China demands dictate everything. Yeah.
Yeah, it's big consumption country at the moment. The next question is by Peter. It's posted to Andrew. Are structured warrants more risky than company warrants?
Okay, so I think we just go back to the basics of what's the difference between company warrants and structured warrants, right? The difference is, I would say it's more or less risky, but structured warrants are issued by banks, whereas company warrants are issued by the company itself on its own shares, right? One of the two key differences is company warrants is usually physically settled. What that means is the option, we talked about a call option just now. The company warrants, if you exercise that option, you actually get a physical share. Whereas for a structured warrant, the exercise of that option is settled in cash. That means instead of giving you an actual share, the difference between the current share price and the strike price, if the current share price is above the strike price, the bank will settle by giving you the positive gains. So structured warrants are generally settled in cash. Now, the second thing is, generally speaking, structured warrants have a market maker, so it's more easily tradable in most cases. So that's the biggest difference between company and structured warrants. Now, whether one is more risky than the other, it's hard to say. It's quite similar, considering
We
it's a
want
very
to talk about
similar
the leverage between both of them.
That entirely depends on the warrant itself. So every different warrant has different terms, different strike prices. So the leverage effect is also different for each of them. So one could be more risky than the other, or vice versa. There's no hard and fast rule of which one is riskier.
Okay. At least when you buy and sell structured warrants, there are market makers, okay, who are doing their best to make sure that the price they bid and ask for you are fair. Okay, but when you trade company warrants, then it is all subject to the supply and demand force in the market.
I would say in general, company warrants are more for people who actually want to pick up the shares in the company, and structured warrants will be more of a trading tool.
Right. So the next question is by Vision. Do I need to calculate the delta and the theta for warrants? We know that warrant got a lot of Greek symbols.
So although the background on how a warrant or how an option is priced is quite complex, well, we've made it very easy for investors by having the price matrix on our website, the one we showed earlier on the slides, right? The price matrix will show exactly what the warrant price is to the corresponding mother share price. So that takes out a lot of uncertainty for investors. So no, you don't need to calculate the delta and theta, but if you want to learn about it and you know how to do it, then by all means, you can do that as well. But to most people, I'd say just use the matrix on our website.
Okay, well said. Okay, the next question is by Queenie. I think it should be posted to Peter. Now, yesterday, there was news about increasing demand for AI chips. Do you think any of our local OSAT players is capable of doing AI chips? As I know, they are now doing auto, mobile, and E&E chips only. And which companies in Malaysia do you think can benefit from this news?
Okay, to split that questions when I said make AI chip, right? Let's split it to a few components in the value chain. First, we talk about design, right? The designing of AI chips. Honestly, no, none of our local players can do it. In fact, most of the designs are, of course, the market leader on top of design is actually your NVIDIA. Microsoft is also exploring designing their own chips, and also even Google. So on that design, no, they're totally out. The second, we talk about foundry. I mean to say, to print the design on wafers, right? Again, there's only TSMC in the world that's doing it, the biggest player. Of course, we have Samsung, which is the second largest foundry. Actually, we call them foundries, right? So technically, foundry for AI chips, again, is either Korean, which is Samsung, or your TSMC, which is your Taiwan, right? The third level, we talk about packaging the chips. Meaning to say, after you do the chips design, you need to package it to protect it. Again, AI chips, if you compare to it, is not the big volume in the world yet, right? Ultimately, it's still being much done packaged by Taiwanese, and maybe to a little extent Korean. So it's not even flowing to Malaysia per se. It's not even flowing to other parts of the world, right? Because the volume is still not not there yet. I give a perspective. We always talk about TSMC produces the 5 nanometer chips, right? And they're able to move to 3 nanometers chip. Samsung is producing 5 nanometer chips. So they say in the whole world, there's only 2 companies that produce 5 nanometer chips. It's either your Samsung or your TSMC. So the news looks very big, right? Wow, no, it's so impressive. But if you take a step back and look at the data, let's increase the size to say 10 nanometers. So 10 nanometers and below, you need to say 10753. The sales for 10 nanometers and below is only 12% of semiconductor sales, which means 88% of chip sales are those large sizes, not the ultra small sizes per se. So that gives a perspective saying that the global semiconductor are still much driven by bigger chips. Although smaller chips captures the headline, 88% of global semiconductor sales are the larger chips per se. So that gives a perspective of AI chips, right? It's still actually very, very small as a percentage of global semiconductor sales.
All right, thank you so much, Peter, for sharing about it. The next question is by Ng. What are some of the EMS and OSAT players that we should pay attention to for investment purposes? Now, recently, there are a lot of IPOs and the choices are increasing. But which are the companies that are worth investing for the long term?
Stock recommendation, very dangerous. EMS are those assembled, helping companies to build their machines, build their devices for them. We call them EMS, right? We have, Malaysia, I think we have close to 20 over EMS companies listed, right? Unlisted. I think the only issue I have with EMS players in Malaysia is the valuation. It's actually quite high. All is above 20 over times PE for EMS. How do you choose EMS? Well, look at their normalized earnings on average. Their net profit margin should be a single digit. If you're well run, should be maybe plus minus 8%, right? That should be the level of profit. And you should compare with that kind of margin to the valuation you're willing to pay. In terms of OSATs, actually in Malaysia, we have 4 OSATs, 4 OSATs. The 3, of course, mentioned the top 25, called Inari, Unisem, MPI. And the 4th, which is smaller scale, was actually Electronics. So we have 4 OSATs in Malaysia per se, right? Among the 4 OSATs, not a recommended, I personally prefer, not recommendation. I personally prefer Unisem. Because if you look at it, 3 years ago, Unisem has a new substantial shareholder that emerged in Unisem, and it's actually Tianshui Huatian. Tianshui Huatian is actually the top 5 largest OSAT in China. They actually bought over the controlling stake of Unisem. So now Unisem is actually a part of Tianshui Huatian. So I think that parentage actually will serve Unisem very, very well.
All right. Thank you so much, Peter. The next question is by Sufyan. What is your view on EV when it has been argued that EV is not ESG friendly?
I totally agree with you. I'm totally with you on this. I am not a believer of EV, to be very honest. I mean, I'm sorry if you guys have EV, but I'm not a big believer. Let's put in a very simple perspective. You look at the automobile, a conventional internal combustion car. You can say close to the whole car can be recycled, right? It's normal metal, it's aluminum block engines, you have rubber tires, you have metal parts. It can be close to 100% being recycled. And look at the whole value chain in the production of car. You're talking about steel, right? Mainly steel, mainly aluminum. Your petrol are mainly exploration of oil. You talk about EV, the whole value chain changes, right? Let's just talk about the battery per se. If you compare the mining of rare earth, of your lithium, etc., versus oil exploration, honestly, which one do you think is more pollutive to the environment? Mining of rare earth is way, way, way much more pollutive. That's number 1. Number 2, you produce this battery, and this battery, huge chunk of battery, until now, there's no way to be recycling it. You know where all the batteries are being disposed of? They're all being buried under the desert because there's no way to recycle these batteries, right? So the problem is people measure EV to be environmentally friendly is only on the specific part of carbon emission. Conveniently, they said EV doesn't emit carbon, whereas your conventional emit carbon monoxide. So yeah, I know it's more environmentally friendly, which I think is totally nonsense. I think to measure environmental friendliness, you should look at the total cradle to grave product life cycle, assess the whole environmental impact before you can say that is environment. Okay, now, case in point in Malaysia. If you drive an EV, sorry if you drive an EV, but you may say, okay, I'm contributing to a cleaner earth. But then bear in mind, 65% of our power electricity are generated by coal. So you are not being environmentally friendly because your electricity that you use to charge your EV comes from coal. right? So how can EV be deemed as environmental friendly?
All right. Thank you so much, Peter, for sharing your perspective in this EV-friendly issue. We have a comment from an audience that says that warrant market makers don't always do their best. So, Andrew, do you have any input, perspective, share with us? You're on mute.
I think I responded to that as well in the chat. But basically, I can't speak for other market makers. Maybe some of them not doing their best or not. I can't say anything about that. But at RHB, we have our live matrix available on our website that we are committed to show our commitment to, the fair prices that we have published online. And we want to make sure that, this method of trading with the live matrix is a lot more transparent for investors as well. So it takes away a lot of the uncertainty of, where would the market maker put their bid and ask, right? Well, it's available on the website at many, many different share prices. You can just see it all there, updated every 10 minutes, every day.
Yep. So the live matrix will make it make the pricing very transparent for all retail investors who want to trade the structured warrants. Yep. So the next question is by Zhisheng. So in the earlier example that you gave, Andrew, approximately 1,000 ringgit investment in Maybank core warrants gives the same exposure as 8,000 ringgit investment in Maybank mother shares. Can I know how is this calculated? Would the ratio be the same for warrants for different companies?
So the quick answer is no. Every warrant has different specifications, so you can't use the exact same ratio for every warrant and every company. But how this is calculated is quite simple. You look at the effective gearing of the warrant itself, right? And then, if 1,000 ringgit will give you, say, 7.9 times gearing, then you're basically getting an equivalent exposure to 7,900 ringgit when you buy 1,000 ringgit of warrants, and so on and so forth. So how you calculate that, use the effective gearing. But I would like to also highlight this to Jason, who asked the question, that the gearing itself, it gives you a return profile that's similar to the mother share, but it won't be exactly 1-to-1, right? It's similar, but not exactly 1-to-1. And but of course, use the website, search for the warrants. The gearing information is there for all warrants on the market, and you can calculate it from there. Also, one last thing, do note that gearing is not a fixed number for every warrant. At different pricing levels, whether it's in the money or out the money, the gearing changes as well. So, keep an eye on that, and just use the website to keep an eye on exactly what the specifications of your warrants are and keep up to date on how it's performing.
So when you talk about gearing, do you mean gearing or effective gearing?
Effective gearing, sorry.
Okay, effective gearing changes. All right. So the next question is by Queenie. Can you educate us on how to forecast cement prices and why is cement price be increasing?
No, actually, it's not forecasting cement prices. Cement prices are okay. This is a bit tricky. It's not forecasting. Let me think of how do I explain it in a non-sensitive manner. Okay, technically, we used to have a ceiling prices on cement, which is regulated by government, correct? So usually producers will give a discount to the ceiling prices, right? So what is happening now is a narrowing of the discount of the cement. Maybe previously they give you 25% discount, but now they're actually narrowing that discount rate. So that's the first perspective, right? So second, you look at it, previously cement companies have been making losses for more than 10 years. I think for the last 15 years, I think the last limit money was 2016. So they've been making losses in the last 6-7 years, simply because the dynamic is very competitive and costs keep going up, right? So if you notice, there was a consolidation of cement players 3 years ago, where Lafarge actually merged with YTL Cement to become Malaysian Cement. So that consolidation of the industry actually reduces the number of players in the market, which to a certain extent give them some pricing power, or the lack of need to compete too much on the prices, right? So that is why you have this price hike in November and December. Because number one, bear in mind, they've been making losses, costs have been increased. They need a new level of prices to be profitable. So of course, there's always a counter argument. Remember in 2018, cement players tried to increase prices, but subsequently developers was making noise over it, saying that they shouldn't and price have to go down. But interesting statistic is this, right? Do you know on average on a per house basis, which costs 300,000? Do you know what's the value of cement being used to build a 300,000 ringgit house? The value of cement is only 2,000 ringgit, which is barely 1%. So when all these developers are making noises, say, hey, increase the cement prices, the house price will increase. Data doesn't show such, right? And bear in mind, all developers have been making good money for the longest of time. So there's really no argument or no reason for them to say cement prices will kill them. No way cement prices will kill them. So long and short, there's a change of industry dynamics, and also the increase in cost prices that actually resulted in the increase in cement prices by the cement producers. I mean, that's a summary of it. Yeah.
Thank you, Peter. The next question is by Steven. Do the sold-out Coldplay and Blackpink concerts signify robust consumer spending in Klang Valley, at least? What do you think?
I don't track Coldplay and Blackpink. That's a good one. But if you really look at it, right, I think the best indicator which you can have, concert is not so frequent, to be fair. I think the best indicator you have about spending power is the number of people in Starbucks. As long as you see there's a long queue in Starbucks, Starbucks is not cheap, to be fair, right? You're drinking a coffee about 16 ringgit. I'm a kopitiam guy, I prefer a 2 ringgit coffee than a 16 ringgit coffee. But look, people are still queuing to pay 16 ringgit for coffee. I think that's the best indicator for consumption in Klang Valley.
Peter, huh? Louis Vuitton also has a long queue every day.
So
economy no issue, looks like. Yeah, I think a lot of...
Look at all those branded goods, right? It's crazy. It's crazy.
I think a lot of young people are looking at Starbucks as a staple. Like it is a staple, like 16 ringgit is a staple.
It's not a staple to me. That one is a premium good to me.
I drink 2 cups a day, so I can't say much.
Staple to Andrew.
I strongly encourage you to continue to drink. So it's a product, it's very weird, right? It's one product which, although I don't consume myself because I can't afford it, but I strongly encourage everybody else to consume it.
Okay. I like how you say you can't afford it. Okay, let me think about that. All right. The next question is by Tu. Do you think the US federal rates increase to counter the inflation have reached the limit and likely to pivot soon? Or is this a temporary pause before the further hike? Bear in mind that the US job market is still strong and inflation is way above Fed's desired optimum level, which could give way to further rate increases.
I think at max, you look at the forecast I shown just now, right? The max looking at maybe 5.1, 5.2 level of interest rate for the rest of the year for 2023. Because bear in mind, the extent of the hike was very, very fast. And usually there is a lagging effect between the rate decision and the real economy. Plus minus, there's always a 6 to 9 months lagging effect before the rate impact flow to the economy. Now we're already at close to 5%. So you really have to wait until the 6 months or 9 months before you can see the impact on the economy. Now the risk to Federal Reserve is this. Already hiked so aggressively in the last 1 year plus, say 1.5 years, right? Do I want to increase it further, risking that maybe 6 months down the road, when I see the real impact, that it could be a slowdown or cause a slowdown? So my take is actually quite aligned with what you just said, right? I think we have really reached the peak of the rate hike. Inflation, yes, now we're at 4% US target is 2%, but I mentioned, I think 2% rate, this 2% targeted inflation has been around for the last 40, 50 years. I think times have changed. I think to me, I think a more rational level is 3%. But of course, who am I to influence the US Federal Reserve? No way. I mean, they're much bigger, right? But inflation is continuing to fall and will continue to fall, right? So it's only a matter of time before it actually taper off the 3% and before it's reaching to the 2%. So long and short, yes, I think that we have reached the peak of interest rate, and likely in 2024, you're going to see a pivot of interest rate, of a rate cut per se.
All right. So what do you think is the Fed's terminal rate like?
Good question. It's anyone's guess, but as I mentioned, my take, it should be around this level. I think it should be around this level.
Around this level, okay. Slightly more than 5, I think.
5.1 factor. I think that's where it should normalize at that level.
All right. The next question is by Siu Leong. What do you think about the future of disruptive US technology, like the recent most popular NVIDIA?
Disruptive technology comes in many, many forms, right? You see, the disruptive technology we see now is your ChatGPT or your artificial intelligence, right? That is disruptive in many, many ways on what we call as the software aspect or the online perspective, right? The capabilities of honestly, whatever we've seen on the ChatGPT capabilities is still the scratch of the surface of what the full potential of artificial intelligence is. So that one is definitely a big disruption, right? NVIDIA on the aspect is more of a chip. So it is a chip that is actually powering the artificial intelligence. Okay, and why NVIDIA is the leader? Because the technology of chips being used to power is what we call as graphic processing unit or the GPU, right? GPU make yes/no decision much faster than your conventional chips. Right? Then again, NVIDIA is a market leader now, but at the same time, you also have other players like Microsoft, as I mentioned, Google, that's also developing their own artificial intelligence chips. Can they match NVIDIA soon? My answer is no. I think NVIDIA has a very, very good market leader advantage because they've been in this GPU. They are the leader in GPU, graphic processing units, right? But again, it is only a matter of time, maybe 5 years, 10 years, before other players start to catch up and eat into the market share per se. So in terms of semicon disruption, NVIDIA will actually definitely have a clear market advantage. In terms of the software aspect, I call it the software aspect. No one have a clear advantage yet. Microsoft may be seen leading at the moment, but Google is also coming up very fast on this aspect of it.
All right. Thank you for shedding some lights here. The next question is by Ken Liang. Do you have any view on the bar vest scandal?
No, I totally don't know what happened. I don't keep track of the company. I really don't.
Okay. All right.
No, actually, Andrew keep track of bar vest. Are you aware of the bar vest scandal? I'm really not aware. I don't keep track.
Not really, so.
Okay. All right. So the next question is by Mr. Abidin. It's posted to Andrew. Are there such things as warrants to manage foreign currency exposures?
At the moment, the warrants in the market are mostly ringgit equity warrants. Well, of course, you can have exposure to foreign counters like Hong Kong warrants, but to specific Forex exposure, then no. Currently on the market, I don't think there is one.
Yep. So there are locally listed structural warrants that give you exposure to the foreign market, like the one that give you the Hong Kong market.
For specific Forex exposure, then no.
Okay.
Yep.
So the next question is by Chen Hian. Since the US job market is still very strong, Peter, so do you think that the inflation rate in the US, especially the core CPI, will not be able to come down to 2%, and this will cause Fed to maintain the interest rate at this high level for a long period of time?
There's a few answers to it. Number one, I do agree that, as I mentioned, I don't think 2% level can be achieved in the short term. And as I mentioned, I mean, this 2% target has been around for 40, 50 years. I think they really need to update what is considered as a targeted inflation rate. As I mentioned, my own view, which really doesn't worth much, I think it's 3%. That would be a normalized inflation rate for me. Will they keep a rate for long? My answer is I don't think so. Right? Bear in mind, US election also coming very soon. Although technically, yes, Federal Reserve is independent of whichever government per se. But what I'm trying to say is, if you look at the trend of the US, whenever it's coming to election, likewise to Malaysia, they have to spur the economy. And the best way to spur the economy to actually to have a conducive business environment, which is also known as a low interest rate environment.
All right, thank you so much, Peter. For the retail consumer sector, won't you think last year is a high base, so this year is hard to show any year-on-year growth? That's by Queenie.
No, definitely for sure, right? Again, depending on what kind of retail you're talking about, right? Definitely there'll be a normalization of growth. Last 2 years after being locked down in our house for so long, we call it as revenge spending. So when you had the chance of market opening, you go out and you enjoy to the max, you spend, and after 2 years, you don't get to spend money, right? Definitely for this year, you're going to have normalization. But that's what I said. To me, a key indicator is how busy are the stores. Whatever you want to invest in, just constantly go pay a visit. Like say, for instance, if you're investing in Starbucks, just constantly go and monitor all the Starbucks. As long as you see there's still crowd, there's still people queuing in, then there's no slowdown per se. But as long as you see that, suddenly the crowd become empty, there's no empty spaces, nobody's queuing for things, that's where the slowdown is.
All right. Thank you so much, Peter. So the next question is by Vijan Nara. So Andrew, are there any AI script that help us in monitor those warrants?
Waiting for you to write, Vijan.
At the moment, no lah.
At the moment, not that I know of. Yeah.
But is it possible at the moment? Like, is it possible for?
I mean, it's always possible. Somebody could even come up with. You don't need AI. You can even come up with algorithmic trading of warrants. Anybody could come up with that as long as you have the expertise to do it. But yeah, at the moment, AI script, not that I know of. Maybe somebody has already done it and is actively trading. I wouldn't know whether one of you guys are doing it. But it's a good idea. If that's something you want to look into, you can look into creating it, of course. But at the moment, I don't think that's one.
I think there's big money to be made if you're able to create one.
Yeah, especially, something like AI can track, many, many different aspects of things like behavioral and everything, not just, quantitative data. Yeah, AI could be very useful, but as of this point, I don't think that's one that's doing it.
All right. Thank you so much, Andrew. So the next question is by Chi Kyong. Peter, can you share with us why do you prefer OSAT to the EMS or the ATA, which commands a higher margin?
Okay, okay, how do I okay, let me know how to answer without offending anyone. Okay, in a very broad summary, I look at the nature of business or how the business is being done, right? But I'm not saying who is good and who is bad, but I'm just saying nature of business, right? In terms of ATE or our equipment space, I think it is a good business. They are very highly profitable, but at the same time, I think the business is hard. I mean to say, you keep on having to tender, bid for orders, and then you get 20 machines, you build the 20 machines, you deliver, then you need to go and bid for another machines, custom-made mice. Because our ATE industry, we are mainly give customized machine. I mean to say, if you want this machine of this spec for 20 units, I'll bid for 20 units, I sell to you. Then I'll bid for another project. Okay, what customization you want? So it's a very constant customization business. It's good, it's high margin, but you need to put a lot of effort. I'm not saying business are easy, but you need to put a lot of effort to keep on continuing that order book to sustain your revenue. OSAT, I like OSAT is because we look at over the last 15 years, if you ask yourself this question, you track globally, who are the new entrants into OSAT space globally in the last 15 years? The answer is zero. 15 years ago, OSAT is packaging. People say it's very low tech. If you got money, you can just go into it. It's true, right? Anybody got money, you can go into OSAT. But for the last 15 years, the technological requirement for you to become an OSAT has surged tremendously. You're not talking about just pure wire bonding of chips, which is the traditional method. You're talking about flip chips, etc. 3D chip packaging, etc. So it is really not a business now that you got money, you can go in. That's why in the last 15 years, you don't see new players coming into the market. In fact, it's the reverse. The market is actually consolidation, that the bigger players are buying out the smaller players. Now, look at the global trend, chip designers. Chip designers now, the trend is they will only design chip. They are not going to get involved in packaging. So as more and more chip design come to the market, somebody will have to produce for them. And these are the OSAT guys who's going to produce for the chip designers. So what I'm trying to say, long and short, the global trend for OSAT is the number of OSAT players has shrink and will shrink further because of consolidation. Whereas chip demand will continue to surge. And you add in these two dynamics, you actually give a very long-term view of the attractiveness of players within the OSAT space.
All right, thank you so much, Peter. Now, looks like time has run out for the question and answer session. While I still have quite a number of questions on my panel, so I want to apologize first if we are not able to address your questions. So before we conclude the sessions, Peter, do you have any closing remarks that you want to share with us?
If there's any indication I give any recommendation, is purely your assumption. I didn't give. It will not stop tips given.
Yeah, likewise,
one.
likewise.
Andrew, there anything to share with us before we conclude the session?
Yeah, same thing. Of course, all our examples we use are purely examples, and it's not a recommendation to buy the shares or any form of recommendation whatsoever. I think financial stuff, you need to figure out what kind of risks and rewards you want yourself. The second thing is, of course, our website, Warrants RHB. Please use that when you want to trade warrants. That's a very powerful tool, matrix, everything is transparent for you guys. So just closing note, use the website.
All right, thank you so much. So it looks like we have a very engaging Q&A session. So ladies and gentlemen, you just heard from Peter Lim, who is the founder and head of research of Trident Analytics, and also Mr. Andrew Lai, who is the warrant specialist of RHB Investment Bank. So thank you all for tuning in until the end of this session. Hope you all gain enormous value from this webinar. So given chance, we would like to bring back both gentlemen to our show again. All right. Thank you, everybody. Bye-bye.
Thank you very much.
Have a good weekend.
Have a good long weekend.
Thank you, Andrew. Thank you.